So the most powerful institution in Washington took a vote last spring. Nobody was elected to it. It didn't hold hearings. It didn't issue a statement. It didn't call a press conference or leak to a reporter or wait for a single member of Congress to find their courage. It simply repriced the debt of the United States government quietly on a Wednesday afternoon in May. And by Friday, the yield on a 30-year Treasury bond had reached 5.127%, the highest level since 2007. 2 days before that, the Treasury Department had sold 30-year bonds above 5% for the first time since 2007. The 10-year note reached 4.595%, its highest since February of 2025. And within hours, the average 30-year fixed mortgage rate in America jumped to 65%. Think about that sequence for a moment. A number moved in a market most Americans have never looked at, and the cost of buying a house in Ohio went up. Here's what most people don't understand about what happened. This was not a reaction to a political defeat. There was no defeat. No election had been lost, no vote had been taken, no concession had been made by anyone in the White House. The bond market did not respond to a loss. The bond market rendered a verdict on the arithmetic, and it rendered that verdict before anyone in Washington was willing to say out loud what the arithmetic meant. And 15 years ago, Warren Buffett told CNBC's Becky Quick exactly how this would end. "I could end the deficit in 5 minutes," he said. "You just pass a law that says that any time there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election." He was half joking. The Oracle of Omaha, 6 decades into reading balance sheets, understood something Washington still refuses to, that a deficit is not a political position. It is a bill. And in 2026, the Congressional Budget Office projects a federal deficit of $1.9 trillion, 5.8% of GDP, nearly double the threshold Buffett said should disqualify every person who allowed it. When you understand what actually happened inside that Treasury auction, and what the number 5.127 actually costs a retired couple in Michigan, you'll understand why the bond market is now the only institution in America that has successfully overruled this presidency, and why it did it without a single vote being cast. Hit subscribe, because this is a story the official statements are not telling you, and it is compounding daily. Let me give you the full context, because this did not happen in a vacuum. It happened because of something that happened first, in April of 2025, and almost nobody outside of Wall Street understood the significance of it at the time. In the spring of 2025, the administration announced a sweeping program of reciprocal tariffs. The stock market fell. That was expected. Stock markets fall, and stock markets recover. And presidents have historically been able to absorb equity volatility as the cost of doing business. What was not expected was what happened in the Treasury market. Investors began selling U.S. government debt. Not foreign adversaries dumping bonds as a weapon, ordinary institutional investors, pension funds, insurance companies, the entities that hold the retirement savings of ordinary Americans, deciding they required a higher return to keep lending money to the United States. The yield on the 10-year Treasury surged more than half a percentage point in a single week, its biggest weekly gain since 2021. And then, on a Wednesday in April 2025, the President of the United States paused the reciprocal tariffs. He said publicly that he had been watching the bond market. He said the bond market was getting yippy. Market analysts at the time called it what it was: the bond vigilantes had won. Not Congress, not the courts, not the opposition party. A diffuse, leaderless, unelected collection of people who buy and sell government debt had applied pressure to the presidency, and the presidency had yielded within 72 hours. That was the precedent. And here is why it matters so enormously for what came next. Because in mid-2025, the administration signed into law the One Big Beautiful Bill Act. It extended prior tax cuts and added new deductions, and it significantly widened the federal deficit. The political conversation focused, as political conversations do, on who gained and who lost, on which constituencies benefited, on the polling. The bond market focused on something else entirely. The bond market focused on the supply. Because when the federal government runs a deficit, it does not simply spend money it does not have. It borrows it. It issues Treasury securities. And every additional $1 trillion of deficit means an additional $1 trillion of bonds that somebody somewhere has to be persuaded to buy. The price at which they can be persuaded is the yield. That is the entire mechanism. There is no politics in it. By March of 2026, federal debt surpassed $39 trillion. To give you the scale of that, the entire annual output of the American economy is roughly $31 trillion. For the first time since the end of the Second World War, the national debt had crossed 100% of GDP. Most Americans do not realize that we have been here before, exactly once, and that the last time we got out of it, it took a generation of post-war growth to do it. Then came the oil shock. The war with Iran drove crude prices sharply higher. By May of 2026, the average price of unleaded gasoline in the United States was holding above $4.50 a gallon, up 51% since the war began. And oil prices feed inflation, and inflation feeds bond yields, because a bond is a promise to be repaid in future dollars, and no investor will accept a fixed return in dollars that are quietly losing their value. So by the second week of May 2026, three separate pressures were converging on the same market at the same time: a widening deficit requiring more borrowing, an oil shock feeding inflation, and a Federal Reserve in leadership transition, with incoming Chair Kevin Warsh facing what analysts openly described as his first serious test before he had properly begun. Something had to give. And on Wednesday, May 13th, in the most consequential room in American finance, a room that does not physically exist, it did. Let me walk you through what a Treasury auction actually is, because the drama of what happened is entirely invisible unless you understand the mechanics. And once you understand the mechanics, you will never look at a headline about bond yields the same way again. There is no trading floor. There are no shouting men in colored jackets. The image most Americans carry of a financial market, the bell, the pit, the ticker, has nothing to do with how the United States government borrows money. It happens through a system called the Treasury Automated Auction Processing System, and it happens on a schedule so routine and so unglamorous that it is almost never covered on television. At 1 o'clock Eastern Time, the auction closes. Before that moment, a small group of financial institutions called primary dealers, firms legally obligated to bid in every single Treasury auction, the designated buyers of last resort for American government debt, submit their bids electronically. Alongside them, indirect bidders submit theirs, foreign central banks, sovereign wealth funds, pension funds, the large institutional buyers who hold American debt as the foundation of their reserves. Each of them specifies two things: how much they will buy, and the yield they require in order to buy it. That second number is the only thing that matters. It is a private judgment submitted in silence by institutions that have no political motive and no press strategy and no interest whatsoever in the reputation of any American administration. They are answering one question, and only one question: what return do we require to hold the promises of the United States government for 30 years? 30 years. Consider that time frame for a moment. A 30-year bond issued in May of 2026 matures in 2056. The people submitting these bids were not making a judgment about a news cycle or a quarter or an election. They were making a judgment about the fiscal trajectory of the United States over 3 decades, a period during which most of the people currently arguing about it in Washington will be dead. At 1 o'clock, the bidding closes. And then, in the space of roughly 2 minutes, the numbers come back. The auction result contains several figures, and financial professionals read them the way a physician reads a chart. There is the high yield, the rate at which the auction cleared, the price the government must now pay. There is the bid-to-cover ratio, how much demand existed relative to how much was offered, a direct measure of appetite. And there is the tail, the gap between where the market expected the auction to clear and where it actually cleared. A large tail means the government had to pay meaningfully more than anticipated to find buyers. A large tail is the market saying, in the only language it has, that it is less willing than you assumed. On Wednesday, May 13th, 2026, the auction cleared above 5%. 5% on the 30-year. the first time since 2007. I want you to sit with what 2007 means, because the date is doing enormous work here. 2007 was before the financial crisis, before quantitative easing, before the Federal Reserve's balance sheet expanded by trillions of dollars, before an entire generation of investors, executives, and elected officials built their careers on the assumption that money is cheap and always will be. Nearly 2 decades of American economic policy, of corporate borrowing, of housing finance, of federal budgeting, were constructed on top of an assumption that had just been formally revoked by the only body with the authority to revoke it. There was no announcement. That is the detail that should genuinely alarm anyone who cares about how decisions get made in this country. No press conference was held. No official rose to speak. The Treasury Department published the auction results on its website, as it does after every auction, in a table, in a plain typeface, without commentary. A row of numbers on a government web page. That was it. That was the entire ceremony. And then the market did the rest. By Friday, the 30-year yield had risen to 5.127%. The 10-year had surged to 4.595%. For both securities, that week saw yields jump the most since the tariff chaos of early 2025, the same episode that had forced the presidency to reverse itself. Somewhere in a Societe Generale research note that week, the head of U.S. research observed on Bloomberg television that bond yields were beginning to feel unhinged. Unhinged, that is a remarkable word for a fixed income strategist to use on television about the debt of the world's reserve currency issuer. Fixed income analysts are, as a profession, the most temperamentally cautious people in finance. They do not reach for dramatic language, they reach for it that week. And in the silence that followed, no statement from the White House, no address to the nation, no acknowledgement that anything of significance had occurred, the number simply sat there. 5,127. Published, permanent, a verdict rendered by an institution that cannot be lobbied, cannot be primaried, cannot be threatened with a tariff, and cannot be persuaded by any argument except arithmetic. But the verdict was only the beginning. What the number did next is what reached into American homes. Because here is what almost nobody in the political conversation was saying that week. A Treasury yield is not a financial abstraction. It is the price of everything. The 30-year Treasury and the 10-year Treasury are the benchmarks off which nearly every other borrowing rate in the American economy is set. When they move, everything moves. And they moved. Within hours, the average 30-year fixed mortgage rate jumped to 6.65%, according to Mortgage News Daily. That is not a projection. That is not a forecast. That is a family in Grand Rapids who was pre-approved on Monday, discovering on Friday that the house they had chosen was now, for them, out of reach, and no one had told them why, and no one would. Then the compounding began. Credit card rates are tied to benchmark rates. Auto loans are tied to benchmark rates. Small business lines of credit, farm operating loans, municipal bond issuance for school districts and water systems and county hospitals, every one of them tied, directly or indirectly, to the number that had just been repriced. The Treasury market is not one market among many. It is the floor the entire structure stands on. And the floor had just been raised. And simultaneously, this is the part that hits the household budget from the other direction. Gas was holding above $4.50 a gallon, up 51% since the Iran war began. So the same American household was absorbing a higher cost of borrowing and a higher cost of driving in the same month, from 2 crises that appeared unrelated on the news and were, in the bond market, the same crisis. And there is a second group affected in a way that almost never gets discussed, because it does not photograph well and it does not generate a headline. The people who already own bonds understand the mechanism because it is counterintuitive and it matters enormously to anyone over 60. Yields and prices move in opposite directions. When the yield on a 30-year Treasury rises, the market value of every 30-year Treasury already issued at a lower rate falls. That is not a risk. That is arithmetic, and it is immediate. So consider the retired couple who did everything correctly, who spent 40 years being told by every financial advisor and every retirement guide and every piece of conventional wisdom in American life that as you approach retirement, you shift out of stocks and into bonds, because bonds are the safe asset, the conservative choice, the responsible allocation. They followed that advice. They moved into long-duration treasuries during the low-rate years, locking in modest returns in exchange for security. They now hold instruments worth measurably less than they paid, in a market where new issues pay far more, and the only way to avoid realizing the loss is to hold to maturity, which for a 30-year bond means holding until 2056. The safe asset was the trap, and nobody warned them, because for the entire span of most of their adult lives, it had not been won. Multiply that by every pension fund in America. Public employee retirement systems, union pension funds, state teacher retirement plans, institutions holding long-dated government debt precisely because it was understood to be the conservative allocation. Their funding ratios shifted in a week on a number nobody voted for. Now consider what this does to the federal government itself, because this is where it becomes genuinely inescapable. The United States carries more than $39 trillion in debt. That debt does not sit still. It matures continuously, and as it matures, it must be refinanced, old bonds retired, new bonds issued at whatever the current rate happens to be. Trillions of dollars of American debt issued during the era of near zero interest rates is now rolling over into an era of 5%, which means the interest bill rises, which means the deficit widens, which means more bonds must be issued, which means more supply hitting the same market, which means yields rise further. That is not a political problem. That is a feedback loop. And a feedback loop does not care who wins an election. Meanwhile, the pressure landed on a Federal Reserve mid-transition, with incoming Chair Kevin Warsh inheriting a situation in which the traditional tools work against each other. Cut rates to relieve borrowing costs, and you risk feeding the inflation that oil is already feeding. Hold rates to fight inflation, and you leave the household under the full weight of 6.65% mortgages. There is no lever that solves both. Analysts had called this his first big test before he had held the job long enough to learn where the light switches were. And the market's own analysts began saying quietly what elected officials would not. One strategist at Standard Bank projected the 10-year would break 5% within the year. The 4.5% level on the 10-year had once been understood, informally, as the ceiling this administration would tolerate before intervening. By the spring of 2026, the market was openly testing whether that ceiling had ever existed at all, which brings us to the man who described this exact mechanism 15 years ago, and to why his verdict lands harder now than it did then. In 2011, in an interview with CNBC's Becky Quick, Warren Buffett said something that was reported at the time as a witticism. "I could end the deficit in 5 minutes," he said. You just pass a law that says that any time there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. And then the line that reveals it was never really a joke. Now you've got the incentives in the right place. Now you've got the incentives in the right place. That is not a punchline. That is a diagnosis delivered in 11 words by a man who had spent 6 decades studying what happens to institutions when the people making decisions do not bear the consequences of them. Buffett's insight was never about the deficit number. It was about accountability architecture. He understood that the American fiscal problem is not a failure of arithmetic. The arithmetic is trivially easy, and every member of Congress has access to it, but a failure of consequence. The people who authorize the borrowing are not the people who repay it. The benefit is immediate, and the bill is deferred. And it is deferred specifically past the next election. In business, Buffett had watched this pattern destroy companies. Management teams optimizing for the current quarter's reported earnings, while the underlying enterprise decayed beneath them. He had spent his career buying the wreckage of that pattern at a discount. So measure 2026 against his 3% threshold. The federal deficit hit 5.8% of GDP. The Congressional Budget Office projects $1.9 trillion for the fiscal year, nearly double the line Buffett drew. Under his rule, every sitting member of Congress would already be disqualified, not as a punishment, but as a simple mechanical consequence, the way a circuit breaker trips. And here is the irony that I would not believe if the record did not document it plainly. In 2026, Buffett's 15-year-old proposal acquired a set of endorsements. Ray Dalio, the hedge fund founder, Elon Musk, who posted "This is the way" in June, and Treasury Secretary Scott Bessent, the sitting Treasury Secretary of the United States, the official whose department was at that moment auctioning 30-year bonds above 5% for the first time since 2007, presiding over a deficit of 5.8% of GDP. The Treasury Secretary endorsed a rule that his own budget violates by a factor of nearly 2. That is the moment. Not a leaked quote, not a slammed door, a man publicly agreeing with a standard that his own signature disqualifies him from meeting, and no one in the room finding it strange. Buffett's own conduct tells you what he actually believes, and it is more damning than anything he has said. Berkshire Hathaway now sits on roughly $373 billion in cash and Treasury bills. Bills, not bonds. The shortest possible maturities, money parked where it cannot be trapped by a long-term commitment to a currency and a fiscal trajectory he has watched for 6 decades. Asked in 2026 whether the market's wobbles were enough to make him deploy that capital, he said they were not. If there is a big decline, he said, we will deploy. He is not predicting a crash. He is doing something more unsettling than that. He is waiting. A man who has spent 95 years on this earth, and 60 of them buying American businesses, is sitting on the largest cash position in corporate history, in the shortest instruments available, declining to commit. That posture is the verdict. He is not betting against America. He is declining to lend to it for 30 years. And what he is declining to lend into is a structure that has already begun to change shape in ways that will not reverse. Start with the households, because the consequences arrive there first and stay longest. A 6.65% mortgage does not merely raise a monthly payment, it freezes a market. Homeowners holding 2 and 3% mortgages from the cheap money era will not sell, because selling means reborrowing at more than double their current rate. So the housing stock stops circulating. First-time buyers are locked out by price and rate simultaneously. Retirees who plan to downsize and release equity find there is no one able to buy. An entire generation's retirement plan quietly assumed a housing market that no longer functions the way it did when the plan was made. Then the corporate layer. Companies that borrowed heavily during the zero-rate decade face the same refinancing wall the federal government faces. Debt issued at 3% maturing into a 5% world means interest expense that consumes earnings, which means reduced capital investment, delayed hiring, thinner margins. This is not speculative. It is a mechanical consequence of arithmetic, arriving on a schedule set years ago by maturity dates that nobody can renegotiate. Then the states and municipalities. Every school district financing a building, every county issuing bonds for a water treatment plant. Every state funding highway construction now borrows against a higher benchmark. Projects get deferred. Some get canceled. The deferral is invisible. No headline announces a bridge that was never started, but it is real, and it accumulates and it lands hardest in the places with the least fiscal capacity to absorb it. Then the international layer, and this is where it becomes strategic rather than merely economic. Foreign central banks are among the largest holders of American debt. Their bidding behavior at auction is watched precisely because it signals confidence in the dollar's role as the world's reserve currency. That role is not a law of nature. It is a preference, an accumulated, revocable preference, sustained by the belief that American obligations are the safest promises on earth. Buffett himself has argued for years that American debt remains manageable specifically because of that reserve status. But reserve status is a form of trust, and trust responds to demonstrated behavior. When yields rise, not because the economy is booming, but because lenders require more compensation for fiscal risk, that is the market repricing the trust itself. And the global bond sell-off of 2026 was not an American event alone. Japanese government bond yields reached levels not seen since 1999. 40-year JGBs hit record highs. Sovereign debt repriced across the developed world simultaneously. This was a systemic reassessment of what governments should pay to borrow. And the reassessment is structural, which is why it will not unwind on a news cycle. Contracts do not unsign. Maturity schedules do not move. A 30-year bond issued at 5.127% in 2026 pays 5.127% until 2056, regardless of who occupies any office in the interim. That is the nature of what happened. The bond market did not express an opinion that can be argued with. It locked in a price that will outlive every person involved in creating it, which is the part that should be sitting heaviest by now. The most consequential institution in American governance held a vote last spring, and no citizen participated in it. It did not campaign, it did not debate, it published a table of numbers on a government website and moved the cost of a mortgage in every county in the country before the close of business. 5,127%, the highest since 2007. $39 trillion in debt, crossing 100% of the economy for the first time since the Second World War. A 65% mortgage rate arriving in the same week that gasoline held above $4.50 a gallon. These are not political claims. Nobody has to agree with them. They are simply the price. And the price is now fixed, and it runs to 2056. Warren Buffett saw the architecture of this 15 years ago and described it in a single sentence about incentives. He was treated as a man making a clever remark. He was, in fact, the only person in the room reading the balance sheet. The deficit did not become a crisis because anyone chose it. It became a crisis because the people authorizing it were structurally insulated from paying for it, and the bond market is simply the mechanism by which that insulation finally failed. Not through an election, not through legislation, through arithmetic, which does not adjourn, does not compromise, and cannot be voted out. The auctions continue on schedule. The next 30-year matures in 2056, and every month at 1 o'clock on a Wednesday, an institution that answers to no one and cannot be persuaded by anything except numbers will meet again in silence and decide what the promises of the United States are worth. Nobody will announce it. It will simply be published.